Picture two people named Margin. One of them works in accounting, wears a cardigan, drinks decaf, gets genuinely excited about a spreadsheet with good numbers on it. The other one works in trading, moves fast, takes risks with money that isn't technically his, and in one single week in March of 2021, helped to raise $20 billion and cost the world's biggest banks over $10 billion of their own. Same name, not even the same personality. And most people watching finance content only ever get introduced to one of them, which means every time this word shows up in the news, half of you are picturing the wrong guy. Boardroom margin tells you how much of your revenue you actually get to keep. Trading floor margin tells you how much of your position you actually paid for. Mix them up, and you'll misread an earnings report, or worse, misread your own brokerage account. So today, both of them start to finish, so you never confuse the two again. Let's start with the business side, because this is the version you'll run into constantly if you ever read a financial statement, a stock analysis, or an earnings call. Two companies can post the exact same $100,000 in sales this year. One of them is thriving. The other is one bad month away from closing its doors. Same revenue, same headline number investors see first, and yet completely different fates. The entire difference comes down to margin, and there isn't just one kind. There are four, and if you only know one of them, you're only seeing a quarter of the real story. Let's build one company from scratch and watch how each type of margin peels back a different layer of the truth. Say we run a small business called Retro Tees, printing custom t-shirts. This year, we sell $100,000 worth of shirts. Nice, so we made $100,000. Not even close. That's just what came in the door. We haven't paid for anything yet. First layer, gross margin. To make those shirts, we spent $40,000 on blank shirts, ink, and printing costs. That's called cost of goods sold, the direct cost of actually producing what you sold. Subtract that from revenue, and we're left with $60,000 in gross profit. Divide that by revenue, and our gross margin is 60%. Gross margin answers one specific question. For every dollar we bring in, how much is eaten up just by the physical cost of making the product before we paid a single employee or turn on the lights? So 60% is ours to keep? Not yet. We haven't paid rent, salaries, or the marketing bill. Second layer, operating margin. Running Retro Tees costs more than just materials. Rent, staff salaries, marketing, all the normal costs of operating the business day to day add up to $35,000 this year. Subtract that from our $60,000 in gross profit, and we're left with $25,000 in operating income. Divide that by revenue, and our operating margin is 25%. This number matters more to a lot of investors than gross margin does, because it strips out something gross margin can't see. How disciplined the business actually is once you count everything required to keep the doors open. 25% operating margin, that sounds pretty good. It is, but we still owe the bank, and we still owe the government. Third layer, net profit margin. Say we took out a loan to buy our printing equipment, and this year that costs us $3,000 in interest. That leaves $22,000 before taxes. At a 25% tax rate, we owe roughly $5,500 to the government. What's left, $16,500, is our net income, the actual number that belongs to the owners of the business after literally everyone else has been paid. Divide that by revenue, and our net profit margin is 16.5%. This is the one number that can't hide anything. Interest payments, taxes, one-time legal fees, all of it eventually shows up here. It's the smallest of the three margins almost every single time because it's the last one standing after every single bill gets paid. Okay, so which of these three numbers actually matters? All three, because they each catch a different kind of problem. A company can have a great gross margin and still be badly run if operating expenses are bloated. It can have a great operating margin and still be in trouble if it's drowning in debt payments that only show up once you get to net margin. They're the fourth kind of margin, and it works completely differently from the other three because it isn't really about historical profit at all. It's called contribution margin, and it exists purely to answer one forward-looking question. How many shirts do we actually need to sell before we stop losing money? To calculate this, we stop organizing costs by category, like cost of goods sold versus operating expenses, and instead split every single cost in the business into two buckets. Variable costs, which change depending on how many shirts we sell, and fixed costs, which stay the same no matter what. Say each shirt sells for $20, and the variable cost to produce and ship one shirt, materials, printing, packaging, comes out to $8. That leaves $12 of contribution margin per shirt, a 60% contribution margin ratio. Meanwhile, our fixed costs, rent, salaries, insurance, the stuff we pay regardless of sales volume, add up to roughly $38,000 a year. So how many shirts do we actually need to sell? Divide your fixed costs by your contribution margin per shirt. 38,000 divided by 12 is about 3,167 shirts. Sell fewer than that, and you're losing money no matter what your gross margin looks like on paper. Sell more, and every extra shirt drops 12 full dollars straight to the bottom line. This is why contribution margin lives inside spreadsheets and management meetings, not on the financial statements you'd see as an outside investor. It's a decision-making tool, not a scorecard. So why does any of this actually matter to you? Because these four margins are exactly why two companies with identical revenue can be worlds apart. Take an average grocery store. Massive revenue, but gross margins typically sit around 20 to 25%, and after paying for labor, rent, spoilage, and razor-thin pricing competition, net margins usually land somewhere between 1 and 3%. That store could do $500,000 in weekly sales and still only keep a few cents of every dollar. Now compare that to a typical software company. Once the product is built, delivering it to one more customer costs almost nothing, so gross margins routinely run 70 to 85%, sometimes higher. Same size revenue as the grocery store, completely different business. That single difference is a big part of why investors will pay a much higher price for $1 of software revenue than $1 of grocery revenue. High-margin businesses have room to survive a bad year. Low-margin businesses don't. That's the entire business side of margin. What percentage of revenue a company actually gets to keep, measured 4 different ways, at 4 different stages of the income statement. Now here's where it gets interesting, because we're about to use the exact same word to mean something almost the opposite. Business margin measures what's left over after you pay your bills. Trading margin measures what you're allowed to borrow before you've paid for anything at all. On a Friday afternoon in March 2021, a handful of banks got on a call about one single client. By the following Monday, that client had vaporized $20 billion in stock, and by the end of the week, one bank alone had lost $5.5 billion of its own money. Nobody hacked anything. No fraud in the traditional sense. No stolen funds. All it took was one word doing exactly what it's designed to do. That word is margin. And once you understand what it actually means in trading, you'll understand exactly how that Friday happened. In investing, margin means borrowing money to buy assets, using the assets you already have as collateral. That's the whole concept. Everything else, margin calls, leverage, forced liquidations, is just this one idea taken to increasingly extreme levels. Let's start small. Say you want to buy $10,000 worth of stock, but you only have $5,000 in cash. I only have half of what I need. No problem. Put up your $5,000 as collateral, and we'll lend you the other $5,000. Now you own $10,000 of stock, but you only paid for half of it yourself. That's buying on margin. You're using leverage, meaning you now control twice as much stock as your own cash could have bought. Here's why people do this. If that stock goes up 20%, your $10,000 becomes $12,000. You pay back the $5,000 you borrowed, and you're left with $7,000 from an original $5,000. That's a 40% return on your own money from a stock that only moved 20%. Leverage doubled your gain. Wait, so I made more money than the stock actually made? Correctly done, yes. That's the appeal. Here's the part nobody puts in the highlight reel. Leverage doesn't know the difference between up and down. It amplifies both directions equally. If that same stock drops 20% instead, your $10,000 becomes $8,000. You still owe the broker $5,000 no matter what. So your actual equity, what's left over that's yours, drops from $5,000 to $3,000. A 20% drop in the stock just cost you 40% of your money. And if the stock had fallen far enough, you could lose more than your original $5,000 ever existed in the first place. That's the entire risk of margin trading in one sentence. It turns ordinary bad days into extraordinary bad days. This is where margin calls come in. Brokers don't just lend you money and hope for the best. They set a minimum amount of equity you have to maintain, called the maintenance margin. If your account value falls below that line, the broker doesn't ask nicely. Sir, your account has fallen below the maintenance requirement. Okay, give me a few weeks to sort it out. We need more collateral by tomorrow morning, or we start selling your positions ourselves. That's a margin call. Deposit more cash immediately, or the broker liquidates your stock for you at whatever price the market happens to be offering that day, which, if you're getting margin called, is usually the worst possible day to be a seller. So how did this exact mechanism help turn one bad autumn into the Great Depression? Rewind to the 1920s. Buying stock on margin was massively popular, and brokers were shockingly generous about it. It was common to buy stock with just 10% down, borrowing the other 90% from your broker or bank. That means for every $100 of stock you wanted, you only needed $10 of your own money. 10-to-1 leverage, available to basically anyone with a pulse and a brokerage account. I want to buy $1,000 of this stock. You've got $100. Perfect, that's plenty. Wait, that's 10 times what I actually have. Everyone's doing it. Stocks only go up. For years, that bet paid off because stocks kept climbing and nobody thought to ask what happens on the way down. Then, in October 1929, prices started falling. Not even catastrophically at first, just falling. But with that much borrowed money sitting under the market, a small drop was enough to trigger margin calls across thousands of accounts simultaneously. Brokers started force-selling stock to cover the loans. That force-selling pushed prices down further, which triggered more margin calls, which forced more selling.